Two life insurance policies sit side by side, both show the same person, both show the same $500,000 death benefit, and both carry the words life insurance across the first page. But one policy has an end date. If the insured is alive when that date arrives, the coverage may end without a death benefit ever being paid. The other is designed to remain in force for life, builds cash value, and may require premiums many times larger. So why would anyone choose the first policy and accept that it may expire? And why would anyone pay so much more for the second? The answer is that term and whole life are not simply a cheap version and an expensive version of the same product. They place different boundaries around the risk. Once those boundaries are visible, the comparison changes. This video covers life insurance in the United States and provides general educational information, not personalized insurance, legal, tax, or financial advice. Policy terms and state rules vary. Any sample numbers are hypothetical and are not quotes. We are also comparing traditional level term with traditional whole life, universal life, variable life, indexed products, group coverage, and survivorship policies work differently and are outside this episode. Life insurance begins with a financial question, not a product question. If a person dies, what obligation or support disappears with them, and who is left carrying the gap? That gap might be lost household income, a mortgage, childcare, education costs, final expenses, business obligations, or long-term support for a dependent. The insured transfers part of that risk to an insurance company. In exchange for premiums and subject to the contract, the insurer promises a death benefit if the covered death occurs while the policy is in force. That promise still has condition must be accurate, premiums must satisfy the contract, and the claim remains subject to provisions such as exclusions and the contestability language in the policy. But financial needs do not all last for the same length of time. Some decline, children become independent, a loan is repaid, savings grow, a surviving partner reaches retirement. The amount of income that needs replacing may be large today and much smaller 20 or 30 years from now. Other needs may continue for life. Support for a lifelong dependent, liquidity for a business or estate plan, or a death benefit someone deliberately wants in place regardless of when death occurs. That creates the first useful axis in this comparison. Duration. Is the need tied to a defined window, or is the intent to maintain a death benefit indefinitely? Duration does not decide the answer by itself. Budget, health, flexibility, other assets, policy guarantees, and the ability to keep paying all matter, but if the duration of the need is unclear, every product comparison begins in the wrong place. Start with traditional level term. Term insurance covers a specified period, commonly 10, 20, or 30 years, though offerings vary. During the level period, the stated death benefit generally remains constant, and the scheduled premium is set for that period. If the insured dies while the coverage is active, the beneficiary may receive the death benefit, subject to the policy terms. If the insured survives the term and does not continue the coverage, no death benefit is paid, and the policy generally has no cash value. That does not mean every term policy simply becomes unusable at the end. Many are renewable for a period stated in the contract, even if health has changed, but renewal premiums normally rise because they reflect the insured's older age, and the right to renew may end at a specified age. Some term policies also include a conversion option. It may allow conversion into an eligible permanent policy without new medical underwriting before a stated deadline. The available product, conversion period, and pricing are contract-specific. Those clauses can matter enormously. Two-term policies with similar premiums may offer very different flexibility if health changes or the need lasts longer than expected. Now, traditional whole life. Whole life is cash value insurance designed to provide lifetime coverage. Traditional policies usually require premiums on a fixed schedule, sometimes for life, sometimes for a limited payment period, and include guaranteed policy values stated at issue. Part of the pricing supports the current cost of insurance and expenses. Part helps build the policy reserve and cash value that support level premiums and lifetime coverage as mortality costs rise with age. That is more accurate than imagining a simple savings account beside an insurance policy. Cash value is part of the contract's internal mechanics. The owner may have rights to borrow against it, surrender the policy for its net cash surrender value, or use non-forfeiture options if premiums stop. Whole life also comes in participating and non-participating forms. A participating policy may pay dividends based on the insurer's experience. Those dividends are not guaranteed. A non-participating policy does not pay dividends and relies on the guarantees written into the contract. This creates two columns that must never be blended: guaranteed and non-guaranteed. The guaranteed column shows values and benefits the contract promises if its stated conditions are met. The non-guaranteed column may show dividends, paid-up additions, or projected values that can change. The NAIC illustration frameworks specifically separates those elements because a projection is not a promise. A useful comparison looks at several future years, not only the final column, and asks what is guaranteed at each point if dividends are lower than illustrated. If a whole life proposal only looks attractive in the non-guaranteed column, that is not automatically a bad policy, but it is a different risk than the sales presentation may imply. Whole life premiums are normally much higher than term premiums for the same initial death benefit. The difference is not a fee for a better version. It reflects lifetime coverage, cash value rights, guarantees, expenses, and a payment structure designed around a very different duration. Consider a hypothetical household. Jordan is 35, has 2 young children, a mortgage, an income the family expects to need for roughly 20 years. The first scenario is simple. Jordan dies in year 12. A 20-year term policy that remains in force would still be inside its coverage window. The beneficiary would submit a claim, and after the insurer reviews it, the covered death benefit would be paid according to the contract. That money could replace income, reduce debt, or fund other household needs. The policy does not decide how the beneficiary must use an ordinary lump sum death benefit unless another arrangement controls the proceeds. Now change the outcome. Jordan survives all 20 years. The term ends. No death benefit is paid. There is usually no cash value to withdraw. At first glance, the household appears to have paid for nothing. But that is the wrong ledger. For 20 years, the insurer carried a defined death risk exposure. The fact that no claim occurred does not erase the protection, just as a claim-free homeowner did not receive nothing from years of home insurance. More importantly, the household's need may have changed. The children may now support themselves. The mortgage may be smaller or gone. Retirement assets may be available to the surviving partner. If the financial gap has genuinely ended, a policy designed to end with it may have done exactly what it was built to do. Whole life could also cover Jordan during those 20 years and continue afterward. It would add lifetime duration and cash value rights, but at a higher required premium. That larger commitment can create an opportunity cost. Money directed to the policy is not available for emergency savings, debt reduction, retirement contributions, or other protection needs. If the household did not need the additional features, paying for them would not automatically create a better fit. This is the first boundary reveal. An insurance policy should not be judged only by whether it eventually pays a claim. It should be judged by whether its coverage period matches the period of risk the household intended to transfer. Now keep Jordan's age and health the same, but change one variable. The household wants a death benefit available whenever Jordan dies because a family member may require support for life. A 20-year term policy still covers the first 20 years, but the need does not end when the term does. Jordan might renew coverage if the contract permits it, but premiums can rise sharply with age. Jordan might apply for a new policy, but a new application may require underwriting and could become expensive or unavailable if health changes. A conversion option may preserve access to an eligible permanent policy without new medical underwriting, but only if Jordan acts before the conversion deadline and accepts the pricing and product available under that option. Traditional whole life addresses the duration problem differently. If maintained according to its terms, it is designed to keep the death benefit in force for life rather than making future insurability part of the plan. But this is not the point where whole life automatically wins. A permanent need does not prove that one specific whole life policy is affordable, well-designed, or appropriate. Other permanent products and legal planning structures exist, and specialized dependent planning may involve trusts, public benefit considerations, ownership decisions, and professional advice far beyond this episode. The central risk now shifts from future insurability to premium sustainability. If Jordan commits to a much larger premium and later cannot maintain it, the original plan can break. Depending on the policy and its accumulated values, options may include reduced paid-up insurance, extended term insurance, surrender, or lapse. Each produces a different result. That is why an actual illustration matters. It should show required premiums, guaranteed values, non-guaranteed values, and what happens over time. A generic chart invented for a video cannot replace it. For the long-duration need, whole life solves a problem term cannot solve by itself. It does not make the death benefit window stop at year 20 or 30. The trade-off is that lifetime duration only has value if the policy can actually be maintained. Permanent coverage with an unsustainable premium can be less useful than temporary coverage that reliably stays in force through the household's most exposed years. This is where the familiar slogans begin to fail. Slogan 1, term is throwing money away. Term buys a contractual transfer of risk during a defined period. No claim is the preferred outcome, not proof that the premiums had no purpose. Slogan 2, whole life is an investment. Whole life has financial value and tax characteristics, but it remains a life insurance contract. Comparing its cash value directly with a stock portfolio ignores the cost and value of the death benefit, differences in liquidity, guarantees, taxes, risk, and time horizon. The reverse comparison can also mislead. Calling every premium above the cost of term savings ignores policy expenses, insurance costs, surrender economics, and the fact that access often comes through withdrawal, surrender, or a loan governed by the contract. Slogan 3, the beneficiary gets the death benefit plus the cash value. Under a standard-level death benefit design, cash value is generally not added as a separate second payment. The beneficiary receives the policy's death benefit reduced by items such as an outstanding policy loan and accrued interest. It is also misleading to say the insurer simply keeps your savings. The cash value helped support the policy and gave the owner contractual rights while alive. The correct question is not who keeps a separate account. It is which death benefit option the contract provides and what rights the owner had before death. Some policies or dividend elections can increase the total death benefit over time. The only reliable answer is in the policy and its current illustration. Slogan 4, you can borrow your money tax-free. A policy loan is a loan secured by policy value. It accrues interest, reduces the net death benefit if unpaid, and can contribute to lapse if unmanaged. Federal tax treatment is also conditional. A modified endowment contract is subject to different distribution and loan rules. A policy that lapses or is surrendered with gain may create taxable income. This is an area for policy-specific tax advice, not a one-line sales claim. Slogan 5, buy term and invest the difference always wins. That strategy may produce more liquid wealth under assumptions about contributions, investment return, fees, taxes, and investor behavior. Change those assumptions and the result changes. Whole life may offer guarantees and a scheduled payment discipline, but those features come with less flexibility and a much larger payment commitment. Neither slogan can replace an apples-to-apples model that includes the insurance benefit on both sides. Finally, neither policy is protected by a federal bank insurance program. State guarantee associations provide a safety net if a licensed insurer becomes insolvent, subject to state law, eligibility, exclusions and limits. In many states, commonly cited baseline limits differ between death benefits and cash surrender value. The practical lesson is simpler than memorizing a national number. Examine insurer financial strength and check the guarantee association rules in the policy owner's state rather than assuming every dollar is backed in the same way. The useful output of this comparison is not a universal winner. It is a better sequence of questions. First, what exact financial gap should the death benefit cover? List the people, obligations, amount, and expected duration. I want life insurance is not yet a defined need. Second, does that gap decline, end on a known date, or continue indefinitely? This determines whether an expiring coverage window is a feature or a mismatch. Third, what premium can be maintained through job changes, emergencies, and retirement, not merely afforded in the first year? A policy delivers no intended benefit if its funding plan collapses. Fourth, which parts are guaranteed? On a whole life illustration, separate guaranteed values from dividends and other non-guaranteed elements. Ask for the basic illustration and examine the premium period, death benefit, cash value, and surrender value at multiple policy years. Do not evaluate only the highlighted projection or one distant retirement date. Fifth, what happens if the plan changes? For term, examine renewal and conversion rights, deadlines, and available products. For whole life, examine surrender values, loan provisions, non-forfeiture options, and the effect of reducing or stopping premiums. Sixth, who owns the policy, who is insured, and who receives the benefit? Those may be three different parties, and ownership can affect control, access, and tax or estate consequences. Seventh, what comparison is actually being made? Same death benefit is not enough. Compare duration, premium schedule, guarantees, liquidity, surrender outcomes, and the consequence of death in several different years. And finally, what evidence is being shown? A quote is not a policy. A sales projection is not a guarantee. A generic online average is not an underwriting decision. Before replacing existing coverage, compare the old and proposed contracts and avoid creating an uninsured gap while a new application is still pending. The issued contract and its approved illustration govern the product ultimately purchased. Return to the two policies from the beginning. The term policy accepts a boundary. Protection lasts for a specified period, usually with no cash value. In exchange, it can provide a larger initial death benefit per premium dollar during that period. Traditional whole life removes the planned expiration date and adds contractual cash value rights. In exchange, it requires a much larger and longer funding commitment. Neither description makes one policy superior. The important question is whether the boundary around the policy matches the boundary around the financial need. If the need ends, permanent duration may be an expensive feature the household did not require. If the need continues, an expiring term may leave a future gap. If the premium cannot be sustained, either plan can fail before it reaches its purpose. That is the mental model. Define the risk, define its duration, identify what the insurer promises, and measure the gap the policy leaves behind. This has been general educational information, not advice for a specific situation. Before buying, replacing, converting, borrowing from, or surrendering a policy, review the actual contract and appropriate licensed, legal, or tax guidance for the decision involved. Life insurance addresses the financial effect of death, but household income can also stop while the worker is still alive. The next episode follows disability insurance from its definition of disability through its waiting period to the portion of income it may and may not replace. Subscribe if you want to understand the contract before the sales conversation. This is Policy Unpacked. Thank you for watching. If this helped you understand the contract before the sales conversation, subscribe to Policy Unpacked and we'll unpack the next one together.